Hi, this is Charlie with your Annuity Master, and welcome to today's webinar where we're going to discuss the power of fixed index annuities. And trust me, these are very powerful products to say the least. Actually, they're so good that Forbes in January of 2020 called them the Swiss Army knife of retirement planning. And they do have a lot of tools. They can be used for a lot of different strategies for your retirement planning. I have sold a lot of these for my clients. We have utilized them for wealth accumulation. We have used them in laddering strategies. We have used them for legacy building. Sky's the limit on what you can do with these things. I have worked with pension employees in moving their money out of state-funded pension programs into fixed index annuities. So we've had a lot of success with these. We're going to start off by going through kind of a slide that I use a lot. You'll see this slide in multiple webinars because I always want to reassure people, continue to reassure people as to their confidence as to where fixed index annuities are on the investment scale. So let's take another look at that now. On the chart, what we see is a red dotted line. Anything below this red dotted line is an investment where your principal is not at risk. Okay. Anything above the red dotted line is an investment that you can make where your principal is at risk for loss. Okay. So let's start at the bottom. And the first thing we're going to see is cash. Cash, put it in a shoebox, slide it under your bed, keep it wadded up with a rubber band around it in your drawer. That's what cash is, okay? It's not going to generate any interest for you, but it's also not going anywhere unless you put your fingers on it and spend it, okay? The next thing you have is a money market account. This is nothing more than a savings account at your local bank. You know, when I was 12 years old and had a paper route, I put all my money into a savings account at First National Bank of my hometown, and I think I earned 3.5% interest on it, but that was back in the, mid to late 70s. And you don't see that anymore. Today, if an account at a bank pays 0.5%, you're doing pretty well, okay? The next thing we have are CDs, certificates of deposit. That is, put in $25 today, and in 30 years, you'll get $28 back. I'm a bit facetious with that comment, but you can see where I'm going with it. Your next stage of investments where your principal is not at risk is a standard fixed annuity. Okay, standard fixed annuity is really targeted for someone who has a pile of money today and they want to start generating a guaranteed lifetime income stream immediately. They don't want the money to percolate and to grow really over time. They have the money now and they want to generate an immediate income starting now. So that's where a fixed annuity would be. Now we're going to jump over to above the red line. First thing we run across are bonds. The next thing we run to are variable annuities. And I am, just to get this out on the table, I'm not a big fan of variable annuities. The primary reason is I feel like it defeats the purpose of an annuity. An annuity is supposed to be a safe investment where your principal is guaranteed and it's supposed to be reliable. And when you have a variable annuity, you are putting your principal at risk for loss. And I feel that defeats the purpose of what an annuity is supposed to do for people who are nearing retirement or in their retirement years and are depending on annuity income. Okay. The next thing you have as we move up the ladder are mutual funds followed by stocks. If you have 401k or an individual IRA plan, most likely that money is going to be floating in more of these top two levels. Okay, but what happens is that as we become older and our risk tolerance begins to decline, we need to move out of the red area and start moving into the blue area to have less risk in our lives with our retirement funds. We're getting older and we have fewer years ahead of us to be able to recoup that money if it is lost. So what we find here is there's a kind of a blank area that you see in the middle, and this is where a fixed index annuity falls into play. The reason why I'm such a huge fan of fixed index annuities is it provides the best of both worlds, okay? It guarantees a principal, but it also provides upside market growth. So it's at the top of the blue section, and it's right on the border of the red section. So you have market upside growth with this, yet your principal is guaranteed. Okay? Now, Our next slide. An indexed annuity is a fixed annuity. Okay, it has all the components of a standard fixed annuity. The principal is guaranteed. The interest credits are guaranteed. The money grows tax deferred. Okay, it can provide guaranteed income for life when you are ready to annuitize it. It bypasses probate. Okay, and it is exempt from Medicare means testing. Okay, and you can also pull penalty-free withdrawals from it. Now, people say no, annuities have surrender fees. They do have some surrender fees. We'll get into the specifics of that, but there are penalty-free withdrawals also allowed in these. Okay, so what is the difference then? Most people ask, what is the difference then between a fixed annuity and an indexed annuity? Okay, well, it's really quite simple. The only difference between the two is how the interest is credited. Okay, a fixed annuity has a standard contract rate that's issued at the time the annuity is purchased. Okay, with a fixed index annuity, your participation rates can vary. Okay, your market growth varies. Okay, because the way it works is a fixed index annuity is tied to an index reflected on the Standard & Poor's 500. Okay, the S&P 500 is the performance of the top 500 companies worldwide. Okay, so you are not invested in the S&P 500. Your money is strictly tied to an index measuring the S&P 500, and that gives you the ability to participate in market growth without the risk of loss. So let's talk a little bit about how this works. Okay, it's not that difficult. Okay, the max and ceiling. Okay, the max or ceiling, which means the top. The top interest that you can earn with a fixed index annuity is based upon a predetermined choice at the annuities application. So when you sit down with your agent to talk about how you want your fixed index annuity to generate its return, there are a multitude of ways that it can be tied to the S&P 500. One of those ways is through what we call a participation rate. Okay, participation rate means, let's say your participation rate is 80%. If your participation rate is 80%, that means if the market returns 10%, you get to enjoy 80% of that, which is 8%. Okay, you're giving up 2%. Okay, and we'll talk about why you're giving up a little bit in just a moment. Okay. The other way is through a cap. Okay, let's say the cap is 8%. Then that means that's the most you can generate in interest annually or biannually or however it's determined with that fixed index annuity. So if the market returns 10% and you have an 8% participation rate, an 8% cap, then that means you will get 8%. If the market returns 9%, you still get 8%. If the market returns 8%, then you get all 8%. Okay? The third way is called a spread. And let's say the spread is 2 points. If the spread is 2 points and the market returns 7 points or 7%, then you get 5. Okay? If the market returns 11, you get 9. Okay? So what you notice is that in each one of these, you're giving up something to get something. Okay? There is a fourth level. It's called uncapped, but typically uncapped is that means there's no limitation, but typically an uncapped is going to have a participation rate limitation to it. Okay, so basically the way this works is that your bottom, so the least you can earn is 0%. Okay, but you never go negative with a fixed index annuity. So what happens is you are trading off to get the low end protection of never being less than 0 on your return. You're giving up a couple of points or a few points on the ceiling level. Okay, so let's say your cap is 8% and the market returns 10% for the S&P 500 that year. You only get 8%. Okay, the other 2% goes back to the insurance company. That's what you are giving up to have the low end protection of 0%. So that's how your principal and your annual resets are guaranteed because you are giving up a little bit to have some low end protection. And that's really a lot of the power of a fixed index annuity and how it works. Okay. So the phrase that typically goes with this, with the floor being 0%, is zero is your hero. Okay, so that's where your security comes from. So you have to be willing to give up a little bit on the upper end to have the low end protection. And when you're a senior and you don't have a lot of years of investing loss recuperation to enjoy, this is a fantastic deal for anyone to take. Okay, now let's take a look at how an annuity is going to perform over the long run. So this chart compares a fixed index annuity and how it would have performed against a strict market investment. Okay, so what we're going to look at is we're going to look at $100,000 invested into the markets back in 1998. Now, the first thing we see here is we see how the market would have performed. Okay, if you had made an investment into the stock market in 1998 at $100,000, you can see that the money grew to about $137,000. And between 2000 and 2002, it drops. That was the dot-com bust when the early dot-coms were overly financed and the market crashed. Okay, then you see the market climbing up through around 2007 and 2008, 2009, 2010, 2011. You see the market tanks there. That was the housing bubble. Okay, and then the market has been climbing basically ever since then. We had a little bit of a dip in 2015. Okay, so this is how a straight $100,000 invested in the market would have performed. Now we're going to look at now how a fixed index annuity would have performed during that same amount of time. And what you see is you see something that is not nearly as volatile. Okay, you are seeing something that is not nearly as volatile, because here's how a fixed index annuity works. Remember, what you get is you're seeing here that between 1998 and 2000, that the blue line goes a little bit higher than the green line. Okay, this is the limitation of either the cap or the participation rate that was chosen for that fixed index annuity. Remember, I said to be able to get protection on the downside, you have to give up a few points on the upside. Okay, so you can see where that's happening in the first few years. But then what you see is this. You see that in 2000, when the market tanks, what does the annuity do? The annuity locked in, and it did not decline. It just stayed flat for 3 years. It climbed to $125,000, and it stayed flat from 2000 all the way through 2002. So that was the floor of 0%. Now, again, starting in 2003, the market starts to climb again. The annuity is going up also. Again, the annuity has a participation or a cap rate to it, so it doesn't get all of the upside. It shares in the upside with the insurance company in exchange for downside protection, because once again, what happens in 2007? Well, we have the housing bubble. The market drops, and what does the fixed index annuity do? It stays level at $156,000 for that 3-year period. So again, that owner of that annuity can be confident. They're not sweating it out. They're not worrying about what happened in the market. They're not worrying about the housing bubble. They are secure in where their annuity sits right now. And then once again, the annuity starts to grow again. By the time you get to 2016, the annuity has actually outpaced the direct market investment by, we're looking at about $15,000, somewhere in there. So this gives you an example of kind of what the ceiling and the floor looks like with a fixed index annuity, and why this is such a powerful, powerful tool for seniors. Okay. Now, another way we look at that is really annuities are becoming the new pension. Okay. We don't see a lot of pension programs anymore. About the only pension programs we see now are at the federal and state level. Private pensions are basically gone. They've all been replaced with 401k plans, people's individual IRAs, because pension funds just are not affordable in today's world anymore. And even at the state level, we see a lot of problems with those. We hear a lot about unfunded pension liabilities on a state-by-state basis. I'm going to show you something on that in a moment. But really, an annuity is the new pension for individuals. Okay? And it's because of these points. One, it's guaranteed Pension programs were guaranteed to be there. There was no risk in them. It generated monthly income. That money was on a direct deposit basis. It was simple and it was reliable. Those are all the components of how an annuity works. It's the new pension of today. Because let's take a quick look at pension programs nationwide. 50 states. Out of the 50 states in the country, only 30 of those states have a combined $281 billion in unfunded pension liabilities. There are only the states of Washington, Idaho, South Dakota, it looks like Nebraska, Tennessee, Wisconsin, and New York that have at least 90% of their pension liability funded. Okay? There are states that have less than 60%. Now, to put that into perspective, that basically means that you have a budget of, say, $10,000 a month, but you're only generating $6,000 a month in income. That's basically what you're looking at here. When you've got a state that's only able to fund 60% of their pension liability, then they're only able to fund $6 out of every $10 in pension liability that's going out the door. So even state pension funds are really, really struggling, and that is having a very bad effect on the employees of those of those pension funds. Okay, because what's happening is the states are having to put more restrictions on those employees participating in those. So I myself have helped several clients move money out of their state pension funds into fixed index annuities to create a more stable investment environment for them. So these are options that can be looked at. Okay, so again, annuities are the new pension for today, but it's a pension that is individually owned and controlled by you. Okay, so let's just talk about another piece of this puzzle, and that is surrender fees, because a lot of people like to really throw a lot of dirt at the surrender fees that are built into pensions. Okay, so let's talk real quick about how these work. Okay, first of all, a surrender fee is there to help assure the money will grow, especially with an accumulation-based annuity. Okay, now a surrender fee is really no different than what happens if you take money out of your 401k plan or your IRA or your Roth IRA before age 59 and a half. If you take money out of your pension fund, your company-sponsored retirement plan, before age 59 and a half, you will be penalized a 10% penalty on that. Okay, plus the IRS is going to tax is really going to hit it hard with taxes. Okay, so that's really the same thing. So anytime you pull money from a retirement type program, you are going to be penalized for that. Okay, that's just the bottom line. Okay, so surrender fees are really no different than that. Okay, now surrender fees, again, they are there to help assure the money will grow. Okay, because how many times have you ever set up a savings account, short-term savings account in your bank, and then before you know it, the money's gone, it's back down to zero because you just couldn't keep your fingers out of the pot. Okay, because you didn't really sit there and let the money grow like it should. The next point, surrender fees decrease annually to $0. They may start at 10%, but year 2 they may drop to 9%, 8%, 7%, all the way down to year 10 by 0%. By year 11, there are no more surrender fees. Surrender fees can be as little as 7 years. They can be as long as about 10 years. That's about the most I've ever seen them be, okay? Now, also, you do have a 10% free withdrawal. So this is where the penalty-free withdrawal comes in. If you put $100,000 into an annuity this year and you need $10,000 next year, you can pull that out without incurring a surrender fee on it. Now, if you have a $100,000 annuity and you pull out $11,000, the first $10,000 you're going to be able to pull out without a surrender fee. The other $1,000, you're going to get a $100 fee on that. So surrender fees are very manageable, especially when you have a 10% free withdrawal annually. And the 10% is based upon not alone on the principal that you first invested, but on the accumulated account value over time. So by year 7, you may have $200,000 in your annuity, and you only have by year 7 a 7% penalty. Okay, that means you can pull $14,000 out of that annuity penalty free. And then anything over that $14,000 is going to have only a 7% penalty to it. Now, the next point about surrender fees is they're 100% waived in the times of critical illness, nursing homes, death, things like that. So surrender fees do not keep you locked down. They are flexible. And there are what we call long-term care riders that can be attached to annuities. And what these long-term care riders do is it states that if something should happen to the owner of the annuity, those funds can be accessed by the family, by the heirs, to help with that person's long-term care needs. In those instances, surrender fees are always 100% waived. Now, here's one of the more powerful things is surrender fees, annuities overall, not just surrender fees, but annuities are exempt from Medicare means testing. Okay, so if you go into long-term care and you need Medicare assistance, Medicare is going to want to know what your assets are before they determine what their contribution to your care is going to be. Annuities are exempt from that means test of Medicare determining what your assets are. So if you've got a $100,000 annuity as one of your assets, Medicare is not allowed to take that into consideration as a determinant for how much they will contribute to your long-term care. So that's a very, very powerful option, a very, very powerful part of annuities, and why it's better than a standard 401k or IRA plan for a retiree. Okay, so the bottom line, fixed index annuities are the Swiss Army knife of retirement planning, as Forbes stated. Again, they have guaranteed principal. They have an annual account value reset, meaning that if your annuity grows 7% one year, you start off in year one with $100,000 and you have a participation rate of 7%. Year two, your annuity climbs to the level of 107. Your account value resets that year and your new principal level is $107,000. So annually it resets. You have no annual service fees. People will come to me sometimes saying, I have an annuity, but I'm getting hit with service fees every year. Last year I was supposed to get a 6% return. I only saw 4% because I have servicing fees coming out. If that happens to you, that means you have a variable annuity. Variable annuities, one of the downsides of them is they have annual servicing fees that are paid to the brokers who sell them. But fixed index annuities do not have annual servicing fees. The next, it's never going to be below 0%. Remember, 0 is your hero. Upside market growth indexed against the S&P 500, and you have lifetime guaranteed income, and then you can have death benefits and long-term care options included within your annuity. So this shows you that this is a Swiss Army knife of retirement planning. So reach out to us, contact us with any questions you have. You can hit the chat button on the side of your screen, or you can hit the contact button at the top, and we will get your questions answered, and we are happy to meet with you and sit down and go over with you what you may already have in the areas of annuities or your other retirement plans, and let us help you figure out how to build an annuity into your retirement strategy. So we look forward to working with you. Thanks a lot.